Good evening. This is Milton Johnson, your financial money coach, here once again on social media. Now I'm streaming on three different ones. So I want to say good evening, Facebook. We got Twitter. We also got YouTube. So I'm doing something a little different, live streaming on three different platforms at one time. So I'm going to see how this works on today. So it's all about growing, using technology, hopefully to your advantage. So we're gonna see how this works. And so it's just a blessing to be able to have you all here with me as we go through this 30-day challenge. And we are more than halfway done. I think this is the 19th day. And so got 11 more days ahead of us. But it's definitely been a blessing to have you aboard. That I say, I am your financial money coach, and I help professionals and small business owners reduce debt and help you increase your savings and investments and for retirement. And I use my roadmap to financial freedom methods to help you get to where you need to be. So I just want to talk about a topic I know that a lot of people ask about and are curious about is why is investing so important? Why is it so important? I hear about investing all of the time. I mean, we hear a lot about the stock market, we hear about real estate, different venues, but why is it so important? So you came to the right place on today about why is it so important. I know a lot of people think about savings account. I've talked about that. And that is very important to a certain degree. Usually a savings account is actually put into a bank and the bank actually pay interest on our money. But you don't want to put all of your money into a bank to achieve your financial goals and retirement goals. Because what does a bank do? They usually pay between 1 to 2% interest at the most. And so the purpose of a bank is actually to get your money and loan it out to other individuals, small business owners, other mid-sized companies, corporations, and they pay an additional interest. And so they make money off the spread between what they pay you and what the corporations, the other individuals are paying them when they repay those loans. So that the bank is in a business of making money. And so they're going to pay you a lower interest and charge everyone else a higher interest. So that's the purpose of a bank. So we know that purpose. And so we know that if we put money in there, we're not going to get a lot of return. But you want your emergency fund money in there so you can have easy access. You don't want to have to sell an investment if you're in an emergency. Wait for that. Wait for that transaction to go through. It may take 2, 3, 4 days before you actually are able to put your hands on that money. So, but a bank is relatively safe. If you have $250,000 or less in the bank, most banks are covered by the FDIC, and they will cover that amount. So I heard people pass on scared of a bank closures, but safety measure were put in place. You had $250,000 or less. You're covered by the FDIC for your money. So we see saving account is not enough. I say, why isn't a saving account enough? Just think about what we've been experiencing the last 2 to 3 years, especially after COVID, the pandemic. I think still kind of have some numbers. But after the pandemic hit us so hard in 2020, we see inflation was off the chart over that, and it's still going up over that time. So a savings account would not keep up with the purchasing power of inflation. You're getting 1 or 2% interest on your money, and inflation is up double digits, 10, 11, 12%. So you're actually losing the value of your money by putting your money into a savings account. So you actually want to invest your money in things such as the stock market, bonds, real estate, ETF, exchange traded funds, mutual funds, things of that nature. And usually, when you invest in things like that, they usually appreciate over time. And as you look at the stock market, certain stocks, you can buy those and the value will appreciate. And some stocks even pay dividends. So every quarter, you would get dividends. I know when I was at UPS, that's one of the things that I did like about the company. I was able to invest in the stocks there and invest at a discount since I was an employee of the company. So you want to take a look at that employee stock purchase discount plans that your employer may offer to you. You may want to take advantage of that. And I was able to invest some money out of my check every time I got paid a certain amount of money. I went to purchase some of those stocks. So that means I became a stock owner. So I became a part owner of that company. So that's what actually you buy some stocks, you actually own a part of that company. And we used to get quarterly dividend based on the amount that we had in there. And another thing was able to vote. There was company directors, or if they wanted to make changes, I was able to vote on those. I had a voice. Do I want that director? Do I want changes to be made? There were certain things. I mean, of course, we couldn't have like the entire direction of the company, but you have a voice in certain things when you are a stock owner. You own part of that company. So that is a great thing. So I look at my portfolio. Matter of fact, I was looking at some things in my brokerage account probably a couple of days ago, and I saw some things saying this one particular company, they having a directors meeting or either a company meeting, and the board of directors is going to be meeting, and they want us to vote on certain transactions before the meeting was actually held. And if I was available, I could actually attend this meeting as well, since I am a shareholder of that company. So if you're a shareholder, they give you the option to actually attend some of those shareholder meetings, or you can actually vote electronically, which I usually do, so I can have my voice. So you have a voice when you own stock. So the main thing about investing, especially when you're dealing with stocks, you want to have a well diversified investment portfolio. And what do you mean? You say, Mills, what do you mean by that? So you don't want all of your stocks in the same, you don't want a single stock, all of it. Let me talk about that first. As I said, I had UPS stock. And some people actually had all of their stock just on a UPS. And there's an advantage and disadvantage of that. Some people, when we went public, the stock doubled overnight. And instantly, people that had been investing over a long period of time, and it created so many additional millionaires because the stock increased double like overnight. I looked at my account doubled. I had thousands of dollars in there at that time. I was like, wow. I was like, man, that's incredible. If I was known I was going to do that, I definitely would have been putting more money in there. But it doubled overnight. And so that's the potential. And you see it with Microsoft, shareholders, Apple, companies like that have been around a long time. The shareholders put like $1,000 in there from the beginning, and they were still holding on. It created multiple millionaires. I mean, people were making money and money, instantly rich over a period of time. Facebook, people that invested in, they multi-millionaires, and the owners are billionaires, multi-billionaires. So that's the impact of being in just one stock. Now the danger of that, if you're in one stock, what if it would have went down to zero? You see some stocks that actually have crashed, and they're no longer in business. Trying to think of that name of that stock that actually went out of business a long time ago. And well, just think about Bear Stearns. They were big banks. Banks were going under. They were big banks. And if their employees had all their money or shareholders had it in one stock, now you have zero. So you don't want. So that's the risk of having it in one stock. It could go up, make you rich, or it could go down and now you're left with nothing. But risk tolerance, but you want to diversify your risk. So you want to invest it in several stocks. So if one is going up, the other one may appreciate. And you may not want it all in one industry. You may not want it all in technology. You may want it in some oil. You may want it in some retail, some auto, some pharmaceuticals. You want a well diversified portfolio so that one industry just won't bring down your portfolio that you work so hard for. So that is something to consider when you're investing in stocks. And these are individual stocks. So to help people with that, there is a solution, which are mutual funds. That takes a lot of the guesswork out of it. So now you actually giving your money to this mutual fund, and you're paying a fund manager to actually manage and make stock selections for you. So that takes the guesswork out of it for you. So you're paying a small fee. Some may charge small fee, depending on which one you have. Some fees are higher than others. So, but you're paying a fee for a money manager to actually manage that portfolio for mutual funds. So to get started, you had no idea. You said, "Well, I want to take the guesswork out of it. Let me just go ahead and invest in a mutual fund." Some mutual funds have done very well over the long term, and this is when you will definitely want to get with a professional when dealing with individual stocks, mutual funds, exchange traded funds, which we usually call ETFs, which are similar to mutual funds. You can do that as well. And another thing you might want to consider are bonds. A lot of people love bonds. I was working with this particular brokerage firm, and I was a Series 766 licensed financial advisor. I had my brokerage license and all of that. We used to sell a lot of bonds, and a lot of rich people love these bonds. I was like, man, so this is the thing. So you actually buying into an instrument and you're loaning them your money. I mean, it could be a corporate bond, it could be a government bond, but you're actually loaning them your money. So, for instance, you may have $100,000, and you say, "I'm going to give them this amount of money for a certain period of time, say for 20 years." And so, for 20 years, they are going to pay you interest on that bond. So, say for instance, if the bond is, I like to use conservative fit numbers. That's what I worked at a very conservative brokerage firm, and say for instance, if it was 6% interest, and so 6% interest on $100,000 bond is $6,000, and usually they would pay it every 6 months. So the first payment would be $3,000, and then the next payment would be another $3,000 for $6,000 for that year. And I see a lot of people like to do this, accumulate bonds. So, say for instance, that same scenario, you get up to $1 million in bonds, and it's paying that same 6%. Now you're up to $60,000 a year, and some people had more than that, say $10 million in there at the same 6%. Now you're getting $600,000 per year. And that's how some people make have passive income, continuous income coming in without really doing anything. You're saving, you're investing, but you can put it in bonds and get that certain amount of money over a certain period of time. And then once that contract ends, say if you had it for 20 years and that contract ends, now you get your money back at the end of that 20 years. So if it was $100,000 bond, you get your $100,000 back at the end of 20 years because you loan that money. Now you get it back. You made some interest over that 20 years, and the bond price could have appreciated. That's one thing. You can sell a bond and you feel like I need to get some money out, and the bond can go up, bonds can go down. But as long as you own it, it's still going to pay that same set percentage. And some people may sell the bonds when they go up. That'd be your discretion of doing that. So the power of investing, it will outpace, you have the potential of outpacing inflation. That's one of the main things, especially with inflation so high right now. You need to outpace inflation. So another good thing with investing is you're getting ready. Hopefully you want to retire. And so this is one of the great things you would want to do is have your money invested. You don't want to put your retirement money, say, into a bank and just let it grow. I mean, that's growing at 1 to 2% interest. Inflation definitely is growing faster than that. You want to increase your buying power. Inflation can decrease your buying power if you leave it in a bank, especially all of it. That's say you just need access to your emergency fund for that, or anything you just need, say you need within a year, you may want to put it in the bank. But long term, you definitely want to put it invested, especially if you have some goals. I know some people say they want to go on certain dream trips, dream house, and this may take some years for this to happen. And to make that, I mean, to make it happen faster, one thing you can do is invest that money, making it work for you. Achieving other financial goals is a must. I mean, that's important to achieve those financial goals that you set. You deserve it. I mean, you've been working hard, you've been having that job, that business. Hey, it's time to have, I mean, reach some goals. I mean, set some goals first, then reach those goals. I mean, I'll say investing can help you do that with compounding of returns. The compounding definitely help. I saw that and continue to see that even with my own investment portfolio, because especially when they pay dividends, usually I would have mine reinvested back into the portfolio. So the dividend check do not come to me; they actually get reinvested, and then the rate of returns on those earnings are also reinvested. So as it grow, you continue to reinvest dividends on the past dividend. Earnings continue to grow on the past earnings. And so it continues to accelerate, which is what we call compounding returns. And then when you're dealing with banks, it's called compounding interest when doing that. So you want to look at the prospect of investing in the right one. I definitely encourage you to definitely seek a professional if you're unsure of which direction to go in doing that, because diversification is key for risk management. I see some people go out there now, so many things, especially with Bitcoin, a lot of cryptocurrency. Some of those are done well, but I've seen like a lot of scams out there. I actually seen a guy, he met someone on Instagram, and they said they promised these great return, thousands of dollars per week with the forex, with cryptocurrency. They guarantee. I hear guarantee. That means run away. That's hard to guarantee, especially in cryptocurrency and forex. I mean, you can't even hardly guarantee anything in the stock market. Stock market is going up and down, so there's really no guarantees with that. The closer I've seen, like if you get an annuity that's covered by insurance products, or like I say you get a bond, and you try to get like a government bond, that's something that's low risk, that had the least possibility of defaulting. Uh, Certain government bonds will last throughout that contract and continue to pay you that continuous interest. But as far as these outlandish about thousands of dollars per week, it's crazy. So you need to kind of run away from certain scams. I actually talked to someone several months ago who actually was scammed by one of these. Um, I don't know what you call these people. I guess scam artists, I would say. But they promised these great returns, and we actually were looking at the account, and he was saying, "Well, I want to sell my shit. I want to sell a portion so I get some money back." He had paid so many thousands of dollars in there, and so he's like, "Man, my returns have grown tremendously." He was looking at his account, it's actually like a fake account, and they showed him all the returns. Um, like more than 10 times what he put it out. I was like, man, that's impossible. I said, I keep up Bitcoin. Matter of fact, I keep up with the market on a daily basis. I say what they showed you. I say that's impossible unless you bought Bitcoin when it was first started, years ago. I say that's impossible. And he tried to get it out. He could not get his money out. They said, well, you need to pay some more money, like a service fee. He did that. And they said, well, we need something else. You need to pay additional money for this. He did it. Then he said, I stepped in. That's when he got in contact with me. Well, another person who knew me got in contact. And we looked at it. I said, man, this is a scam. He said, they got me. I said, they sure did. They just showed you an account that made return, but you can actually get any money out of this account because it's a fake account. So beware of those scam artists that try to take your money. You want to look into a reputable, especially when you want to start trading a reputable brokerage company to actually start trading money in. And then if you need some help, definitely look at a professional. You can seek out me. Like I said, I've been dealing with investing now for like over 20 years in all. So I know something about investing. But I made a lot of mistakes in the past. So you don't have to make the same mistakes I made. You can learn from what I did. I want to make sure you don't make the same mistakes I made years and years ago, and make sure you stay on the right path. And one good thing that investing can do, and I like this, it can leave a legacy. So, for instance, if you grow your return, let's say, like when I was at UPS, or we had P&G and some other big companies, you grow your return, something happened to you, you actually can leave some of that money to your heirs, or you have a will. You say, well, I want to enjoy some of my money, but some part I want to be able to create a will and then leave some to my heirs. I want to leave some to my children, my children's children. Create a legacy. And that's how we really like grow generation to generation. Money is passed down, keep passing down. But it's important that we teach our children, our children's children, about being financially disciplined, about money, how to spend money, how to invest money. Because when they get into a lot of money, usually they don't know how to spend it. And usually they're spending on things like they're going to get designer clothes, a big car, they're going to go on trips, they're going to be going out, they're going to be throwing up shops and spending their money on crazy things. And next thing you know, all the money is gone. So it's important to actually teach them some money discipline. And then in order for you to teach them, you need to be learning as well. Continue to learn and grow and get better. And then if you have any more questions, or feel like, after this replay go out there, and you say, I don't have an understanding about something, or I like to work with you, Milton, on certain things, definitely feel free to reach out to me. You can DM me, look on my link, go to my website, go to contact. You can set up an appointment. You give me a call, and then we can go from there. I look forward to rocking and rolling with you, helping you achieve your financial goals and your retirement dream. Again, this is Milton Johnson, your financial money coach, and I look forward to seeing you on tomorrow. You be blessed.